Okay, it's 9:30, so I think we'll get started as planned. Thank you everybody for joining us this morning. It's lovely to see you here, and welcome to Matt and Tim, our presenters this morning. Tim and Matt collectively expect to be speaking for about half an hour, potentially more if we have some Q&A or we get engrossed in conversation. If you do have any questions, please feel free to post them either into the chat box. We will answer any questions that we have at the end, but if it is too complex or it does contain anything that has personal data in it, obviously we'll come back to you afterwards. All being well, the recording from this session this morning will be available on our YouTube channel or on our website later today or tomorrow morning. Just a brief introduction before I hand you over to Matt and Tim. For those that don't know, RPGCC, we are ranked in the UK top 50 firms by accountancy age. We climbed 10 positions in the rankings last year, and we know that given our growth trajectory, that will continue into next year. We were also ranked in the top 16 as UK providers of audit services for listed companies in the UK. So again, something that for a firm of our size we're quite proud of, and again we're hoping to see that improve as we go through the following year. We have offices here. I'm in Gracechurch Street this morning, and we also have an office in Woburn, which deals with our digital and small business team. We currently have around 15 partners, and there are around 90 staff, although that does seem to be growing on a regular basis. We are a full service firm. We cover all areas of audit, accounting, bookkeeping, payroll, corporate and personal tax. We also have separate departments that deal with corporate finance and M&A, as well as having Matt and his team in our financial services branch. I think that's it from me. As I said, any questions in the chat or the Q&A, and we'll cover them at the end. I'm now going to hand you over to Matt and Tim.
Thank you, Kay. Good morning, all. Now, primarily what we're going to be talking about today is the impact that the autumn budget happened in 2024 and how this impacted pensions and inheritance tax. Now, the autumn budget was one of the most anticipated budgets in recent time, primarily driven by the change of government. Now, the pensions impact that it has, there are a lot of rumours on the rumour mill about what the Chancellor may have done to pensions, and the one that wasn't on the rumour mill was the inclusion of pensions within inheritance tax calculations for individuals. It did come to a shock to all of us in the industry, and I'm going to show you how that has changed the way we plan and use pensions for individuals. So initially, a recap of how death benefits were calculated for individuals pre-budget, and you can see there on the screen, pre-age 75, individuals with unused pensions could pass to any beneficiary they chose without any tax. If the member passed away after 75, the benefits would be taxed at the recipient's marginal rate of income tax. So it was quite a favourable vehicle to transfer wealth down to the next generation if you didn't need to draw upon it. So the big change in the budget that brought the death benefits into individuals' estates, and the taxation changes are listed here on the screen. Again, pre-75, there wouldn't be any income tax charged to the recipient, but from April 2027, there will be taxation at inheritance tax rates, which is 40%. If the individual passes away after 75, the beneficiary will pay income tax and IHT rates. Now, this is quite an inefficient method of passing down wealth. As you can see on the screen there, this double taxation has an effective rate of 67% for additional rate taxpayers. So it's got us in the industry scratching our head, thinking, how can we plan for this? Because that is a high level of tax, which individuals will try to mitigate. So I'm going to run through, excuse me, just a quick summary here of how we would plan to accumulate wealth and spend the wealth pre-budget. So going back to those taxations pre-budget, what we'd look to do is advise individuals to fund a pension with additional surplus cash first to try and secure that additional tax relief. If they'd maxed their pensions out and wanted to save some more, look to fund ISAs and furthermore general investment accounts if ISAs were fully maxed out. Now, historically, the planning had been you save in that pecking order, and on the converse, when you start to spend, to use the FCA's term, to decumulate, you do the reverse. So you leave your pension to be the last in the pot there because it has the best tax efficiency should you not need to draw upon it. Now, come April 2027, that pecking order has seemingly changed. Again, on the way in, it remains the same because the tax relief is quite attractive on the way into pensions. But you can see on the bottom there, we've considered advising clients to use the pension first. So as the income need for individuals occurs in retirement, you use the pension first, deplete that, and should you want to do any inheritance tax planning, you can use your ISA or your GIA to do so. Now, in practice, we do tend to take a slice from each of the three products there in retirement so that you're not being taxed too heavily at any one time. As I said at the start of the webinar, it was one of the most anticipated budgets, and all of these thresholds were on the rumour mill to have been affected. The annual allowance for one, the tax-free lump sum being 25% of the pot. There was lots of rumours that that was going to be changed to 100,000, and tax relief on the contributions as well. I think that's been on the rumour mill for every budget going back as far as I can remember, but they all remain the same. Now, a key planning angle that seems to have come out post-budget and post-discussions with other financial planners is using protection to mitigate that potential inheritance tax impact. Again, if you had intended to leave your pension to the next generation, they will incur that inheritance tax bill if you don't take some action. So we've got a couple of suggestions here that we are in discussion with clients about considering. One would be to create a drawdown plan, therefore crystallizing the pot and taking an income. Now, with that income, you can either do some gifting, so gift out of income, which is not included within inheritance tax calculations, or purchase a whole of life annuity plan. Now, the benefit that would have is on death, the beneficiaries could still inherit the capital value of your pension, albeit charged at IHT, but they'd also benefit from the proceeds from a whole of life plan. So that should provide the funds to pay any additional inheritance tax. Or the second option on the screen here is purchasing an annuity with your pension pot. Now, that has two benefits in the fact that gets the capital value of your pension pot outside of your estate for inheritance tax calculations from day one. So that means you have other assets that could hopefully be within your £1 million threshold with your nil rate bands, or look to do other planning with it. But purchasing annuity and then using that income from the annuity to purchase a whole of life plan again, which does provide that tax-free lump sum on death if written in trust for the beneficiaries. So I'm going to run you through a quick example of how that could be applied in practice. Now, we have a dummy case here with Mr. Smith in good health with £1 million defined contribution pension pot that he had intended to live to his children. Now, using that £1 million, we could purchase an annuity, a single life annuity, providing him £2,664 per month after tax for the remainder of his life. Now, using that income, he could either gift out of income, or in this plan, we can purchase a whole of life plan for providing a cover of £2 million written in trust. Now, when Mr. Smith dies, that £2 million whole of life plan will be paid out to the beneficiaries tax-free, and his estate will be £1 million less because of the annuity would be placed outside the estate from day one. Although I must caveat, it is good conditions here, that he is in good health and not a smoker, and it is a case-by-case basis, but in practice, we would tend to hedge the bets and look to advise a bit of both. So you still have access to the capital if you need it, but you've got this planning angle that can protect your beneficiaries against future IHT. So long story short, there are still planning options, and we do still to continue to engage with clients on this as a topic for engagement. Just the goalposts have now moved. And with that, I'll pass over to Tim, who will cover some other inheritance tax changes post-budget. Thank you.
Thanks very much, Matt. Good morning, everyone. So, today I was just going to cover off some of the other changes, but I thought it's always useful, I think, just to make sure everyone's fully aware of just the concepts of inheritance tax and when it's charged and what's chargeable. So, at the moment, inheritance tax on a death estate is charged at 40% on assets above 325,000. Now, what that means is essentially you are adding up the value of all of your assets in your estate, and as Matt has just told us about, that will now include pension pots, that will include your main home, it will include investment portfolios, it will include the car, it will include jewellery, it will include any asset in your name. From that, you can deduct any liabilities. So if there's like mortgages on the house, for example, you are able to deduct that to come to a net figure on which 40% tax is then charged. Now, there are reliefs from inheritance tax. So as we said, everyone gets a £325,000 on their death. If you are leaving assets between spouses, they are generally exempt from inheritance tax, the gifts between spouses. So that also means you can transfer the £325,000 between spouses. So if you leave all of your assets on the first passing to your spouse, then on the second passing, the second spouse to pass away will get 2 times £325,000, so 650 to deduct from the estates. That £325,000 has been frozen until 2030. It has been at that level since 2010. So there's a lot of what we would call fiscal drag in that threshold. So that would mean, just by inflation alone, growth in wealth overall in the country, that HMRC will be taking a larger tax take by having frozen that threshold of that limit. It used to go up by inflation every year, and in 2010 they stopped that, capped it at 325, and it's been that amount ever since. There is a separate allowance related to the main property that can, in theory, take the allowances up to £1 million when the spouse is involved and the property is left to the children or other descendants. However, that £1 million starts to get tapered if your total estate is worth more than £2 million. So you'd have to have essentially a house worth £1 million, but total assets worth less than £2 million to qualify for the full £1 million allowance. And it's quite unusual to find that circumstance. So I've never really seen anyone qualify for the full £1 million in practice. It's quite tricky. So we've mentioned a few reliefs there. So everyone gets the normal rate band. You can qualify for the spouse exemption. Matt referred to another relief called the gifts out of income. But there's also other reliefs on marriage, things like that. Now, there's also just generally what we would refer to as a potentially exempt transfer. So that's where you are making a gift during your lifetime, as opposed to the tax on the death estate. Now, if you make a gift during your lifetime, you need to survive 7 years from the date of the gift for it to be fully outside of your estate. Now, if you pass away within the first 3 years, that full amount is brought back into your estate and you pay 40% tax on that. Between 3 and 7 years, the full amount, if that gift is brought back into your estate, but you're paying a tapered amount of tax. So that tax rate starts to reduce down from 40% by 8% per year until you get to 0 after 7 years. So there isn't, in theory, a limit to how much you can make as a potentially exempt transfer. So if you survive the 7 years, you can essentially gift as much as you like. There were rumours, for example, a few years back that Bernie Ecclestone gave away £1 billion as a potentially exempt transfer. It's completely possible to do that. There is no upper limit. If you survive the 7 years, that is then outside of your estate. There are also reliefs as opposed to exemptions, but in the past they effectively amounted to the same thing. So agricultural property relief relates to, as you would expect, farms and sort of ancillary buildings, so your barns, your farm cottages, the actual land, that sort of thing, anything used in the farming trade effectively. And business property relief is a more general relief for businesses that includes sole traders, partnership shares, and shares in a trading company. And there's no minimum share ownership in an unquoted company. You can qualify for business property relief just by having 1 or 2% of an unquoted company. You don't have to control it. And that relief was unlimited previously, but the change from the budget is that from 2026, the relief is going to be capped to the first £1 million of value. And after that, it will be 50% relief. So previously you had 100% relief on the full value. That's going to be capped at £1 million and then 50% thereafter. Now for AIM shares, historically they had been used as part of a sort of inheritance tax planning method, because you could have what is in effect a listed share, but because it's not on the full stock markets, they were given additional relief. So you could qualify for business property relief by investing in AIM shares. That has been restricted to 50%. So unlike for unquoted companies where you get the first £1 million at 100, for AIM shares, it's just going to be a flat 50% relief. Now, there was a slight question mark how all this was going to apply to trusts. And just last month, HMRC issued a consultation where they set out their thoughts on how this might work for trusts. And then essentially they're going to get the opinions of other professionals and try and understand what it all means, and to make sure everyone is clear on how the rules would work. If they've missed anything, then people get the opportunity to comment and say that you haven't really covered this scenario. But generally, there was, from that consultation, there was quite a bit of clarity as to how it was going to work. In reality, there was only 1 or 2 ways it could work when it relates to trusts. And the main question was whether you got £1 million in your lifetime to give to a trust, or just as with the nil rate band, does it refresh every 7 years? So a gift into a trust is normally immediately chargeable to inheritance tax at the lifetime rates, so that's 20%. But if you give up to £325,000, that's within your nil rate band. There isn't any tax to pay anywhere. If you're contributing in business property relief assets, so essentially, most commonly that would be shares in an unquoted trading company. If you put those into trust, they could qualify for business property relief such that no immediate lifetime charge would arise. So the 20% charge on the transfer into the trust would not arise. So historically, as we've said, that was an unlimited amount, but going forward, that's going to be limited to £1 million. So from April 26, you're really going to be able to put £1 million worth of BPR qualifying assets into a trust without incurring a lifetime charge. Anything above that, you'll get 50% relief, which will effectively make the 20% tax rate become 10%. So you'll effectively pay 10% inheritance tax on a gift of BPR qualifying assets into a trust. Now, what we weren't clear on before the consultation was whether you could then do another trust later on, or whether that £1 million was spread across every trust you ever set up in your lifetime. It's been clarified that you can, in fact, set up another trust 7 years later. You get another 325,000 nil rate band, you get another £1 million business property relief allowance, and the trust will benefit from that allowance. So on the next slide, we'll go through an example of how that you might benefit from that and why it's worth considering utilising business property relief now, whilst it's available before April 2026 when these changes are coming in. But one last thing I just wanted to mention on the changes as well was that this was slightly not really highlighted when talking about inheritance tax in the budget, but it's certainly a new interesting concept. So at the moment, as of today, the inheritance tax is charged on all of your UK cited assets. And if you're UK, what's called domiciled, then you're paying UK inheritance tax on your worldwide assets. If you're not UK domiciled, you're only paying tax on your UK cited assets. The concept of domicile is not one specific to tax law. It's a general concept in law in this country. It's more to do with where your roots are, your heritage, whether you came to the UK for indefinitely, or whether you have an intention to leave. It's kind of a vague concept, and often the person who's suggesting they don't have a domicile in the UK isn't around to defend their case because they've passed away before it ever gets tested, and therefore it's quite tricky to prove. To try and simplify things, what's going to happen now is that rather than looking at domicile, we're just going to look at residence, which is an easier test based on day counting. So if you become what's called long-term non-resident, you'll then become liable to UK inheritance tax only on your UK cited assets. So for example, a property in the UK will always be a UK cited asset and will always be liable to UK inheritance tax. But if you've got, a bank account overseas, you've got investments overseas, if you're a long-term non-resident, so that's going non-resident for 10 or more years effectively, then you can come outside of the UK inheritance tax net. That's not really been an option available to people with a UK heritage before, but it is now an option that people can leave the UK for the long term and come outside of the inheritance tax net. So it's an interesting idea. I appreciate 10 years is a long time and a big commitment, but it's at least a possibility. So just coming back to this idea of business property relief. As of today, there's nothing to stop you qualifying for an unlimited amount of business property relief. However, if you were to pass away within the 7 years, the amount you've gifted today would be brought back into your estate. And at that time, only the first £1 million is going to qualify for full relief, and then 50% thereafter. So the fact you get a full business property relief today doesn't necessarily mean much if you pass away after the 5th of April 2026 within that 7-year period, because that will all be brought back into your estate. However, one thing that is advantageous is potentially the use of a trust. So as I mentioned before, a gift into a trust is normally liable to an immediate 20% inheritance tax charge. However, a gift before the 5th of April 2026 will be effectively exempt from inheritance tax if it qualifies for the 100% business property relief. So there's an opportunity to get business property relief qualifying assets into a trust. As we said, you do still need to wait for the to live for 7 years after the gift for it to be completely outside of your estate, but that's true of any sort of lifetime gift, to be honest. But it's a way of getting assets into a trust above sort of the £1 million limit, if that's a limit that applies to you, that's going to affect you. What it doesn't do, so trusts, because the assets inside a trust are not in anybody in the individual's estate, trusts themselves have their own inheritance tax charges. So every 10 years, a trust has a 6% inheritance tax charge. Now, as we said, that 6% inheritance tax charge, when that's calculated, you can qualify for the £1 million business property relief and the 50% thereafter. So in effect, it becomes more a maximum of 3% of inheritance tax charge every 10 years. So that's so whilst there is an inheritance tax charge, if you've got shares in a family company, it can be funded by dividends. As long as you're aware that charge is coming, it is still an efficient mechanism to move assets outside of your estate. The main reason for using family trusts is actually a lack of trust. It's really to retain control over an asset. So you're getting an asset outside of your estate, and yet you're retaining control of it. You're retaining control of the income, the capital in the asset, and in the event of a divorce or something, the asset is not in the estate of the person being divorced. So, for example, if you were to give shares directly to down a generation, that too would achieve much the same thing. You're getting the asset outside of your estate. It's a potentially exempt transfer, so you're not saving any tax per se at this point by banking it now. As long as you survive the 7 years, it will be outside of your estate. But that asset will then be in the next generation's estate. And what happens then? are they of an age where they need to do their own inheritance tax planning? Do you want to skip a generation? What happens if they get divorced? Some of those shares will suddenly disappear to somebody that's not no longer a family member. What happens if they go bankrupt, the insolvency? The trustee in bankruptcy will want to sell those shares and realise that income. So the use of a family trust is really for control. It's for asset protection. So this is an opportunity to move assets outside of your estate whilst retaining control of those assets, because effectively you could be the trustee of that trust and therefore you're in control of what happens within that trust. And as it's, particularly if you've got shareholdings, for example, you can also be in complete control as to when dividends are paid. There's no entitlement under these trusts. It's just as and when the trustees decide to make distributions. So we do think it's worth considering at this point banking BPR relief if the circumstances are right. If they're, it could include even if you're looking at a sale. To us, it doesn't necessarily mean you need to keep the shares. It might be a way of getting value outside of your estate whilst you do qualify for BPR. So yeah, it's definitely worth considering if you've got some trading assets that you could exceed the £1 million threshold essentially. So yeah, if that's the circumstances, then it'd be worth having a conversation and working through that in more detail to understand if that's of benefit to you. Okay, and that's me done.
Thank you very much, Tim. Thank you very much, Matt. On the screen now, you can see both Matt and Tim's contact details. If anybody wanted to take a quick shot of those. If not, you can always contact us at hello@rpgcc.co.uk. We haven't had any questions come through, which I can see Tim and Matt both sighing with relief. We're not about to put them on the spot. But if you do have any questions that you did want to send over, please feel free to send them to Tim or Matt, or you can send them again, as I said, to the hello box, and we can pick them up from there. I do just have to show you this quick disclaimer slide. I don't expect you to read it. RPGCC Financial Services is separately regulated by the FCA, so they don't fall under our ICAW regulation. I think that's it from us. Dead on time. We've done well this morning. So thank you all very much for joining us, and we look forward to seeing you again soon. Have a lovely day and enjoy the sun. Bye-bye.